What's going on, guys? Welcome to another Market Radar podcast. Hope you've had a great week. We're recording this on the Friday session. The market has not closed yet. We're looking at the NASDAQ right now. It's just barely holding on to Momo right there. It's the last index out of the four that we monitor, S&P, Russell, and Dow Jones. It's the NASDAQ is the last one to hold on to its bullish trend. And, as the saying goes, bearish trends tend to lead to lower prices. So if the NASDAQ does flip here, we're going to have all indices going lower with downward pressure. And so right now we've got the S&P, Russell, all of them leading the way down. We'll see if the NASDAQ can hold up here, but it's really not looking good. It got stuffed today after it made an attempt to bounce higher. But the main topic of discussion lately has been bonds. Seeing a lot of people trying to long bonds here, trying to catch the falling knife. So that's what we're going to dive into today. Is it really worth catching the falling knife? Is this the low in bonds? What to really expect going forward, and what kind of tailwinds we're seeing in the near future, that can contribute to further price drops in bonds. But before we go into that, Gamma, take us through what we saw this week, and we'll get into bonds afterwards.
Right. So this week we saw a few key data points come out, just pointing towards again the economy remains pretty much resilient. Right. We had the home price index print back in positive territory for the first time since May of this year. So we were negative, but now we're back in positive territory. New home sales were pretty much unchanged since this time last year. GDP came in at 2.1% for the second quarter, and the third quarter estimates from the Atlanta Fed are still hovering around 5%, right? So that's still strong. Jobless claims are still at the lower end of the 52-week range, which means there's no issue in labor at the moment. And we had PCE come in on Friday on a year-over-year change, just slightly accelerating from the prior month, down from a year ago, and still in line relatively with the forecast that were expected. So nothing's really being thrown out of whack here. This all comes back to the fact that, remember, in stage three, so in the compound landing, obviously in stage three, it's all about normalization. What that means is if there is no recession, there is no reason why the long end should be lower than the front end, right? Now, that doesn't mean that there is no recession, that there is not going to be a recession of any kind. It just means that if the market thinks that there isn't going to be a recession, and the Fed will have to remain vigilant for a very long time here, in the inflation fight, then the long end needs to go higher. And that's what's been going on. Obviously, bonds have just been pretty much, I don't want to say this, but pancaking, right? What they've been doing the last couple of months here, and just going straight down, yields going up, especially on the long end, while the front end remains fixed. Now, let's talk about what is shifting within the market because of this move, right? So obviously higher yields without a sustained economic growth environment in the economy is not that good for equities. Currently, growth is strong at the moment, or resilient, I should say, but that doesn't mean it's going to always remain resilient. The market is forward-looking, so it looks at rates going up, and the big question everyone's asking, which is a valid question, is the borrowing costs keep rising. So if they keep rising, at some point, there's going to be an issue. And this is all laid out in stage three of the compound landing. And then that's what this whole extra or additional tightening and additional restrictiveness that is created when the long end goes up, which was laid out and is the driver for what comes next in the cycle of the compound landing, which is stage four. And that is the actual economic slowdown. Long story short, though, the market isn't really liking the current environment as much, given we take a look at ES. ES flipped bearish trend this week. So this is the first bearish trend indicator on ES since February of this year. So we've had this bullish run in equities. Now we're back to bearish trend. And another thing under the surface that's been shifting is volatility. So if we look at VIX, VIX is fighting for its life to hold above Momo. On Friday, we had this nice flush back down to mid-vamp. Mid-vamp held like a charm. Now we're back above Momo. And obviously, any price above Momo exponentially increases the odds that we are going to see a trend flip. Trends can't flip if prices are not above or below Momo in that direction. So for us to get a bullish trend, VIX has to be above Momo, and VIX is fighting to stay above Momo. Now, as long as it can stay above Momo, it's going to add a lot of headwinds to equities. And something that we follow, those that watch us on Twitter, you guys know we look at the Volley TDEX. The Volley TDEX is above 1.5 now for looks like it's going to be the second consecutive session here, or third consecutive session, excuse me. And this is going to act as a headwind for equities. The higher this goes, the more fear that's going to be baked in rapidly into the market, and it's not going to end well for equities as long as this is the game plan. Now, remember, keep this real simple. As we always do at Market Radar, we're not trying to reinvent the wheel here. If the trend is bearish, volatility is supportive for lower equity prices, let the market go where it wants to, right? So it looks like the market wants to go lower at this point. Doesn't mean the market's going to crash, right? Obviously, with VIX holding up above Momo, you elevate the risks of a more concentrated selling environment, but in terms of equities, but we have yet to see that. So long story short, go with the flow. Equities were able to go up in bullish trends. Now, as the trends flip across the indices, especially ES, right? ES is leading. NQ may get a trend flip next week, depending on what happens. Then the odds for higher prices shift drastically off the table, where it's no longer likely prices are bound to go higher. Remember, bearish trends tend to lead to lower prices, and bullish trends tend to lead to higher prices. But this all has to be wrapped and encompassed into our regime, right? The regime that we're following. And those that are following us, following our reports, you know the regime that we're in. If you're interested in finding out what regime we're in and learning more about our more in-depth tools, you can go to our website, and we offer a daily report where we post all of our analytics based on our tools and our indicators. But long story short, you know that at Market Radar, we are looking for the two lineups, the system and DDOP lineups for the right trend moves, the valid trend moves, the ones with real thrust and real profit potential. Without the lineup, it's more of a mixed bag, and things can go either way. So we're waiting for the lineup to strike hard because we use leverage. If you do use leverage, excuse me, you want to make sure you have all the wind in your sails, because without that, you can get very, very hurt in a sideways to real downward trending market with leverage, with the volatility drags on these products. So you have to be very careful on how you construct your portfolio. But anyways, back to the bond market, right? Because everything's going to revolve around the bond market right now, because rates are the real movers. Equities are going down. Equities are feeling some of the pain of this lift here in rates, and volatility is obviously accelerated. And now we are seeing, as we laid out in stage 3, pretty much happening in the exact manner that we said it would. The yield curve will start to revert, but it will not be the recession reversion.
Well, so I'm going to stop you there. One question that I think a lot of people are wondering, because there's so many people buying the dip in bonds now. I believe the inflows in TLT over the last year to date have been highest ever recorded. So people are trying to buy the dip on bonds, and year to date. How long will it last for? So this bear steep that we're getting questions of how long is this bear steepener in stage 3 going to last until we get to stage 4? Is there really a time frame that we can put on this sell-off, and if it'll continue?
Right. So I've answered this question a few times in terms of like other people like looking for guidance in terms of the compound landing and like a kind of like a calendar on how it would work. There is no calendar in markets, right? You can put kind of like target dates out there for where things should kind of progress, but this is a roadmap, not a calendar, right? So things will progress and they will happen and things will unfold as they cycle through markets, right? And some things take longer, some things take shorter. It would be very ill-advised to try and construct a time frame on how this works, because in reality, nobody knows. This is not how this works. What has to happen now is we have to price out the recession in the bond market, and that's what we're trying to do. That's what the yield spread climbing towards zero is trying to do. They're trying to tell you that the 10-year yield is climbing against the 2-year yield, is trying to price out that recession. And typically, and I want to emphasize why this is different, right? Why is this move higher in yield in the 2s and 10s not the same as what you might see going into a normal recession historically. And this comes down to the difference between the bear and the bull steepener. Now, this is our yield curve analyzer indicator, which you can just add on TradingView. It's a free indicator, and you can overlay it on the 2s and 10s, and you can get an idea of over the last few weeks what the moves are looking like in the spread in terms of bear, bull, steepeners, and flatteners. Now, typically, a bull steepener happens when the front end of the curve, when the Fed is cutting interest rates. That's when a bull steepener happens. That's the signal of a recession. Now, both of these steepeners indicate the yield spread going up. So if you just look at this and you see this going higher, many people will confuse this move as the bull steepener. It is not a bull steepener because the long end is actually rising faster than the front end is, and that's what's reverting the curve. Now, why is this happening? Why is this different than the bull steepener? Well, what's happening right now is we haven't gotten a recession, and the market's been basically proven wrong at every point, or the participants, right? The bears have been proven wrong at every single point that there is no recession, and a recession becomes less and less likely. People start to throw the idea out the window, and they end up having to price out the recession. The problem with pricing out the recession is you are essentially pricing in the recession at the same time, in the manner that when you price out the recession, long end yields have to climb substantially. Now, the Fed is tight on the front end, but the back end is still kind of loose. I mean, we're discounted to the front end, where basically the back end is saying the front end rates will come down at some point, and we don't need to go that high over the next 10 years. And lo and behold, that's starting to change slowly as the long end rates move higher. And what that's going to do is it's just going to add more restrictiveness, which means, for example, even though the front end of the yield curve is pretty steady, the Fed's not hiking interest rates, mortgage rates are continuing to climb, right? They continue to just go up because the long end is rising, and mortgage rates are linked to the long end of the yield curve. So even if the front end doesn't move, as these long end rates go up, borrowing costs for things, any type of like 5-year note, like a car or anything, house, any type of long-term loans, they go up in borrowing costs in the process. And all that does is just add additional restrictiveness to the economy. Even though everyone's pricing out the recession, they are essentially, by doing so, making conditions even stricter for a market that's been rapidly tightened in such a short time frame. So it's a very interesting landscape we're looking at right now.
Is there a threshold that we need to cross where we start seeing things breaking? Like if let's say the 10-year gets to 5%, is there any concrete threshold like that, or is it more so just the duration that these yields remain at these levels?
That's a good point. I do think it's more the duration, right? I don't think you can point to somewhere and make a threshold. And here's the reason, right? We just came out of COVID. We didn't just, but we came out of COVID as the last cycle into this cycle, right? Where we had the economic boom, right? After the bust, right? But in terms of monetary policy, there was the boom, and the bust were the same thing, right? So the economy fell during COVID, and the Fed unleashed basically extraordinary stimulus, right? And even though the market rebounded, they didn't change that. So the market and the Fed aren't aligned, essentially, right? The Fed went from extraordinary stimulus to pretty much extraordinary tightening. Forget the market going up and the market going down, right? So we're coming into an extraordinary tightening cycle from an extraordinary stimulating cycle, and there's a lot of like things that lay over each other. So if you just look at, for example, the yield curve's been reverted, the yield spread, the 2s and 10s have been inverted since July of 2022, yet there's no recession. And the yield curve is now trying to revert and go back towards zero, again, with no recession. Now, why is this happening? Well, it's just an extraordinary cycle all around. We're coming from record stimulus to record tightening, rapid move in inflation. Everything's kind of thrown out of balance. And there is no point where you could say, could the yield curve pretty much revert and go above zero, right? Where the 10s are actually above 2s and nothing breaks. Yeah, it could happen. And there's just a lot of lags that are built up that typically that reversion is the recession. Sometimes they do start out as bear steepeners, as we've been seeing, where the economy's like, oh, we're getting a soft landing. Everything's going to be fine. We need to raise the long end of the yield curve because there is no recession. There's no reason to discount it. And then lo and behold, that itself creates the hard landing, right? Then the bear steepener turns into a bull steepener real quick, and it just accelerates as the Fed cuts rates and we hit a recession.
And at that point, that's when the long bond trade will reveal itself, and that's when
Yes,
really the TLT play, those longing TLT, will finally have some relief and
right.
make some profit.
Because theoretically, if you look at the yield curve and you look at how it reverts, reversions when it goes from negative to positive and rips hard, those are the best time to own bonds if it's a bull steepener. But if we're rising towards zero on a bear steepener, all that's going on is the long end is lifting. The long end is changing at a much faster rate than the front end to the
Well, so
upside.
what are some risks that are looming that can accelerate this bear steepener and stage 3 that haven't hit us yet?
So, okay, that's a good question. Now, that has to do with pretty much foreign central banks. It's not so much. I don't foresee there being that much of an issue with this with the Fed here and exacerbating stage three. I think it's going to be a foreign thing, right? So, for example, if the BOJ wanted to end yield curve control, right, and they wanted to basically reshore their currency, right? They wanted to bring currency back.
Which they've already stated they're thinking about.
Right, they're thinking about. And they would have to bring yen back into the United States. What they're going to do is they're going to start selling treasuries. If inflation becomes basically as inflation becomes problematic for other countries, it slows down, or inflation remains problematic for other countries, it slows down the stage three effect in America. Because long story short, other countries are, for example, Japan. Why would you own the yen? It makes no sense to own the yen if inflation's where it is and yields are where they are. Your negative real yields, you're going to go out and you're going to try and basically chase better or more supportive income vehicles like U.S. Treasuries that are in a very strong and positive real yield environment. Therefore, as you chase real yields or you're chasing Treasury bonds, you're putting like a ceiling on the yields, right? So as the conditions worsen overseas, you're basically capping the yields on the long end over here. What ends up happening is when they basically reverse, where things become more favorable overseas, real yields are stronger, the economies are stabilizing, so on and so forth. You're taking money back home, and you're basically, instead of putting a cap in yields, you could think of it putting it a floor, because everyone's dumping their treasuries, pushing yields higher to convert back to their own currency, right? And or they're no longer, they're not, maybe not dumping is the wrong word. They're no longer participating in the auctions. They're taking money back out. Therefore, yields have to go up. And obviously this is old news, but we all know, we spoke about this a couple of months ago, or a month ago, I should say, that the Treasury refunding program, or the refunding schedule, I should say, that comes out every few months, signaled that in quarter four of this year, they're expecting about 65% of the new money raised to be from the coupon section of the bond market, meaning from duration. And that's not something that the bond market likes to see, which is also why yields have been on fire lately, just going up, because we've gone from this inflation issue to a supply issue. And that's very, very visible when you just look at something like the 2 and 10 year, right? So if we're looking at the 2 and 10 year, excuse me, not the 2 and 10 year. We want to look at 10-year break evens. So let's look at 10-year break evens, right? So 10-year break evens remain pretty much anchored, right? But the 10-year bond just keeps climbing. Now, why does the 10-year yield keep climbing and the break evens aren't going nowhere? And this is the same for the 5 years as well, right? The reason for this is the move in yields is not inflation driven yet. So the reason the 10-year break evens haven't gone higher is because the market's not really anticipating a move in inflation. And this goes back to commodities as well. As you try and normalize the economy and you're trying to price in more resilient growth, remember where inflation, or I should say resilient demand, where the market was a year ago. Think of it like this: 2022 market dies down on growth slowdown fears, and 2023 we rebound on the idea that growth slowdown wasn't as bad as expected. Commodities, on the other hand, are now pricing that in as well. They're like, okay, well, if we're not going to get a recession, then there'll be ample demand and commodity prices have to go up. And that's going along the lines of bond yields as well. And that's why you're seeing this expansion in real yields. Now, the problem is expanding real yields continue to add more and more pressure to the economy. Again, the wider real yield, or the higher real yields get, the more enticing they become to suck up money out of the economy, right? Because the higher the risk-free adjusted rate after inflation becomes, the more money people are going to throw at it because it's risk-free, right? So the higher that goes, the more money it sucks out of the economy, the more it slows things down. And lo and behold, the more restrictiveness is added, and that therefore you basically slow the economy down by the economy thinking that it can speed up. And that's pretty much what stage 3 is of the compound landing. And then eventually something happens, and if it's yields, creating a yield crisis somewhere, whatever it is, timing that is irrelevant. It's a fool's game. Just know that the further this type of move goes, the more restrictiveness is going to be added to the economy, and then we get to stage 4. And once stage 4 unfolds, depending on the severity of the situation, we can either have a shallow recession, a shallow and prolonged recession, or a deep recession. That's how this will work.
That's important that you said timing this is a fool's game. It's really difficult to do that, and those that are longing TLT that have been doing that for the past year have just been getting destroyed. And you just got to remember it's not going to be that quick. This is large macroeconomic movements happening here, and catching the bottom is, especially with leverage, which is what we will be doing, it's just not worth it. There's going to be confirmation that comes in. Obviously, you're not going to get the exact bottom if you're waiting for confirmation as that gets priced in. But it's better to have some confirmation that a bottom is in, and that stage 4 and deflation is starting to show itself. That's the best time where you get that best risk to reward ratio. Whereas now you're in the dark. There's no way of knowing this stage 3 could last another 6 months. Who knows? Something needs to break, and knowing what that is or when that's going to happen is it's nearly impossible.
Yep. Or the dive is real shallow, right? In the economy, the slowdown is shallow, and we can theoretically get a soft landing, glide through this. I'm not saying that's what I think is going to happen, but you have to keep your mind open for anything, right? Like, could that happen? Of course. If I was to tell you that could not happen, I would be ignorant. I'm not going to tell you because it could happen, right? You have to keep your mind. You have to open your mind up to possibilities. Do I think it's the most probable outcome? No, but we're given the way that we do our analysis and our framework, the narrative is always the passenger seat. So the compound landing is just a guideline of what's going to happen. Like, for example, bonds are uninvestable. Uninvestable. You cannot put money in. We cannot put money in this. You can do whatever you want. But this is just straight bearish trend. Signals are off. There's no good bond trade here. You can claim you bought the dip and whatever, but you're catching falling knives, right? In the long game, this is not the buy. This is not an investable chart for us. Same thing goes for equities. If equities are in bullish trend, it's not investable.
I think the way this is going to play out, even once we do get into stage 4, equities might really not be the play. Even in stage 4, when deflation does hit, equities might not even get hit that hard. We're still fairly low, relatively low, compared to where we used to be. And a stage 4 deflationary hit, equities might not even drop that much. So playing that recession hard landing with shorting equities would not even have a good risk to reward. Obviously, that can change. There's still a lot that can happen before we do get that stage 4. But I think the best risk to reward trade is going to be bonds once that happens. Even if it is not that hard of a landing, even if it is somewhat of a soft landing, I think bonds will be the better trade over shorting equities.
Right. And now obviously we haven't even, we've spoken about this briefly, but we could get that shallow scenario where equities are long. And that's why, you don't want to be in, I want to say shallow landing where the economy actually grinds out a positive risk environment with a slowdown. As stupid as that sounds, yes, that's possible, where the economy is slowing down gradually, but not really going negative. We're holding on to positive territory for our dear life. And the system basically can differentiate the economic cycle there, put us into a risk on environment with equities remaining bullish, and we grind that out. That's totally possible. Now, timing that's impossible, right? Guessing the outcome is impossible. You just have to let the regimes come to you. They will unfold. They will play out. As long as you're watching, paying attention, and executing on a high level, you will capture them. If not, then you're going to miss a lot of things and wonder what is going on. That's why it's very important you stay up to date with how the regimes are forming, how the regimes are shifting, and where we are leaning to at every point in the cycle. So again, I recommend you guys go check out our website at market-radar.com. We post our reports there daily, every trading day, so you can see what's going on our internals. But that should wrap it up for this podcast. Thank you so much, guys, for listening. If you guys want to follow us on Twitter, we have a Twitter. Our Twitter is @the Market Radar. So that's @the Market Radar.